Should you escrow your taxes and insurance as part of your mortgage payment? It depends, and I'll explain why in this video, Escrow Accounts Explained. You want to buy your first home, but maybe you don't have 20% to put down or perfect credit. That's okay. If you're committed to a home purchase, then I'm here to help you do just that, maybe even sooner than you thought possible. My name is Scott WYNN, and I am a licensed mortgage advisor with the WYNN and Egan team at Citywide Home Loans. If you want to buy a home in the next 12 months, then click that subscribe button, and together, we'll make it happen. You might be wondering whether you should escrow your taxes and insurance as part of your monthly mortgage payment. Well, I'm going to share with you why the answer to that question depends. So stick with me as I explain how escrow accounts work. Most people pay more than just their mortgage as part of their monthly mortgage payment. Your payment probably includes P, I, T, I, and MI. You might also have an HOA, but generally the HOA is paid directly to the HOA itself. So let's take a look at this monthly payment and share with you what portion goes into your escrow account. So first of all, P, principal. This is the amount that's going to pay down your loan balance over time. Then you have the first I, which is interest. This is the amount that's going to the lender for the fact that they provided a loan to you so that you could buy the house. Next is T, or property taxes. This is one of the items that goes into your escrow account. The second I in your payment is homeowner's insurance or hazard insurance. This is another item that gets put into your escrow account. And last is MI, or mortgage insurance. If you put less than 20% down on a loan that requires monthly mortgage insurance, you'll then have mortgage insurance as part of your payment, which also goes into your escrow account. When you get your monthly mortgage bill, you'll see this broken out on your payment. Sometimes there's two major buckets, principal and interest and escrow, and other times it'll actually break down each parts of this payment. One thing I should explain here is that even if you have a fixed mortgage, it doesn't necessarily mean that this full payment is going to stay fixed. The only portion of your payment that's going to remain fixed is the combined principal and interest payment. But over time, the amount that's going towards principal is increasing, and the amount that's being paid towards interest is decreasing. But again, combined, it'll always remain fixed. The rest, the T for taxes, the insurance, and the mortgage insurance, all of that is subject to change based on whatever those actual amounts are. At closing, your lender is going to fund this escrow account, or at least get it started. And the amount that they're going to collect is going to depend on a few different factors. So let's talk about insurance first. See, insurance generally is required to be paid in advance, meaning you would pay right now for the next 12 months of insurance on your home. Then each month when you make your monthly mortgage payment, that portion of insurance is going to be added into the escrow account so that when next year the insurance comes due, they have enough money to pay the full year. The lender is also going to collect a cushion that is up to the maximum allowable according to law, which is 1/6 of the annual amount, which roughly comes out to about 2 months worth of insurance. And that's what they'll collect for insurance at the time of closing to fund your escrow account. Taxes work almost exactly the opposite way. Unlike insurance, which is paid in advance, the taxes that you pay this year are for last year, and the taxes you pay next year are for this year. And taxes don't necessarily get paid on the anniversary of your closing like insurance does. Both of these things complicates how the escrow account is funded at the time of closing. The amount of taxes collected at closing are going to be based off of when the next due date is for taxes. Sometimes taxes are paid once per year, and sometimes it's twice per year on specific months. So the lender will calculate out when the next due date is and how much is due at that particular time and collect the appropriate amount of taxes at the time of closing to ensure that they have the right amount funded along with your monthly payments so that that tax bill can be paid on that next due date. Generally, this means that they're collecting somewhere between 2 and 6 months worth of taxes. But if you're purchasing a home, one thing to keep in mind is that you're going to be paying taxes when they come due for a time period that the seller owned the home. So to avoid this, what happens is a seller tax credit is provided to you to offset the amount of taxes that the seller should have paid during the exact amount of time that the seller owned the home. In addition to the cushions and the amount of money necessary to set up the escrow account initially, there's also a small credit that's provided. The lender will determine at what point does the escrow account hit beyond that maximum and then provide that variance in the form of what's called an aggregate adjustment at the time of closing. Then, every month when you make your monthly payment, the right amount of taxes, insurance, and mortgage insurance, if you have it, gets put into the escrow account. When those bills come due, now the mortgage company has enough money set aside in the escrow account in order to pay those on your behalf. Every year you'll receive a statement. It looks a lot like a bank statement because that's basically what it is, and it's called an escrow analysis worksheet. Basically what it shows you is the starting balance from what was funded at the time of closing or from the ending balance of the previous year for your escrow account. So you've got your starting balance, then it shows the transactions, the deposits being made from your monthly payments, as well as the debits of the amount being paid on your behalf for taxes, insurance, and mortgage insurance, resulting in an ending balance. Now what happens from there depends on what that ending balance is. If the ending balance is positive, then you're in good shape. And sometimes there's even an excess amount in that account that a check is provided to you that's your money, you can then deposit it into your account. However, sometimes there's a shortage. Generally, this shortage occurs because taxes have gone up or insurance has gone up and there wasn't enough money set aside in the escrow account in order to pay that for you. So there was a shortage. Now, in this particular situation, you have two options generally provided to you. The first is to just pay that shortage in one lump sum at that particular point in time. The other option, however, is to take the shortage, divide it over a 12-month period of time, and just add it to your monthly payment. Either way, your payment's likely to go up when a shortage occurs because the mortgage company needs to make sure that they're collecting enough next year to be able to pay the higher amount due when that bill comes due. So that's how escrow accounts work, but you might be wondering why mortgage companies require escrow accounts in the first place. Now, a lot of people will say that it's because they're greedy, because they want to earn the interest on your money. Well, I'll say that that's probably not the case. In fact, I believe that the reason that this is set up is because they're protecting their interests. There are really two areas where a mortgage company can get into some hot water, if you will. The first is if taxes are not paid, because as you can imagine, the government takes first position to take over the home in the case that property taxes are not paid. Well, a mortgage company who has hundreds of thousands of dollars most likely lent out to you doesn't want to risk losing their collateral, the home, in order to recoup that cost if you stop paying your mortgage. So to avoid this, they want to make sure that those taxes are paid, and therefore paying it themselves is probably the best way to ensure that that's done. Same thing holds true with insurance. If you don't have insurance in place and something happens to the home and you decide to stop making payments because there's no home anymore, such as like a fire that burned down the home, well, now the mortgage company's on the hook for a debt that isn't being paid on a home that they can't sell to recoup their cost. Best if they just collect it from you and pay it on your behalf. This all leads to the question, should you escrow? Well, first of all, if you're putting less than 20% down, you likely don't have a choice. And that may not be a bad thing, which I'll explain here in a moment. If you did put 20% down using a conventional loan, then you will generally have the option to what's called waive escrows, which avoids the escrow account. But you should know that if you do qualify to waive escrows, there's normally going to be a cost associated with doing this. Generally, the cost is about 0.125% of your loan amount, or about $375 on a $300,000 loan. The cost may be rolled into your interest rate, which you may not even notice, or potentially be a cost at the time of closing. It is just a one-time fee, not an annual fee or anything like that, but it is a cost nonetheless. Sometimes there may be no cost at all. So why would somebody waive their escrows, even if they had the option to do so? Well, a lot of times it comes down to control. People just like to have control over their money. And with an escrow account, even though it's your money, it's not in your account and you don't control it. Some people just don't like that. Another reason is what I mentioned a bit earlier, the interest that could be earned on the money in that account. But let's get real here. The average interest rate on a savings account these days is just 0.05%. And on a money market account, the average is 0.08%. And at best, on a 12-month CD, you're looking at 0.18%. So if we look at, let's say, an escrow account with a balance of, let's say, $5,000 over a year at a 0.18% rate of return, you're looking at getting about $9 in interest. But what if you invested it? And what if you could earn, let's say, 10% on your money? Well, the thing to keep in mind is that you're not necessarily going to have the full amount of the escrow account sitting in there at any given time. Most of the time what will happen is it'll start at a fairly low balance, increase over time until the taxes and insurance come due, which then depletes the balance and lowers it. But if we just assumed $5,000 being equally added to each month throughout an entire year, so the ending balance equals $5,000, the amount of interest you could earn at a 10% interest rate if it were invested in, let's say, the stock market or something like that, would be about $80. I just don't see the point of waiving escrows for either of these reasons. But there is one reason where waiving escrows, I think, could make sense, and that's when you refinance. See, when you refinance, what happens is you pay off your existing mortgage and replace it with a new mortgage. But when a refinance is completed, what happens is a new escrow account is set up with that new mortgage. Well, again, the money in the previous escrow account is yours, and so what will happen is, generally within around 30 to 60 days after closing, you'll receive a check in the mail from your previous mortgage company giving you the balance of what was sitting in that escrow account. But with the new mortgage, the escrow account had to be funded at the time of closing, so taxes and insurance were collected. If you had waived escrows, those taxes and insurance wouldn't need to be collected. No matter which way you do it, it's going to be a wash. The amount that you're going to pay towards taxes or the amount paid towards insurance is going to be paid. It's either going to be paid by you through your own energy of collecting the money and setting it aside and paying it when it comes due, or letting the mortgage company do it for you. So I guess the question I have is, do you want the convenience of the mortgage company doing all that for you? Or would you prefer the control and potentially some small amount of interest that you could earn on your own money to do it on your own? Just consider this if you're thinking about waiving escrows. Consider all the areas in your life where you pay for conveniences. Things like going to Starbucks for a cup of coffee, going out to eat so you don't have to cook or do dishes, ordering a delivery service through something like Grubhub or Uber Eats, or even ordering something online through Amazon. All of these are areas where you pay a fee, a premium, in order for a convenience to occur for you. And basically an escrow account is super convenient. It's a company that's not charging you anything to do this and pay for your taxes and insurance for you and properly adjust your payment each year so that you don't have to think about it. I would say that for most people, escrow accounts aren't that bad. In fact, I would say they're pretty nice and convenient.
Did I answer the question you came looking for? If not, leave your question in the comments below and I'll be sure to reply. And if you found the info helpful, I'd love a click on that like button. If you're serious about making your first home purchase, check out these other videos as you work towards buying a home. Or you can call or text me and I can help you directly.